A few notes on today's event, a link to today's presentation and a link to the video of this webinar, which we are recording, will be sent out to all attendees within 24 hours of the event. The PowerPoint presentation is already posted at proformative.com/resources. So if you would like to download this, print it out to make notes as we follow along, etc., feel free to do that. You can do it right now at that URL, proformative.com/resources. We are offering CPE credits for today's event. If you would like to receive those CPE credits, A, you need to have signed up when you're registering for this event, and B, you need to take the 3 polling questions that we will be asking today during the course of today's webinar. Now, those polling questions are actually statistical in nature. We'd love to get everyone's input on those. So whether or not you are here for CPE credit, we would appreciate everyone taking the 10 or 15 seconds to answer each of those polling questions. That would be great. But if you're here for CPE credits, you must take those. Next up, please do ask questions today. We will begin with a presentation from our speaker, who I'll introduce in just a moment. But we also have a Q&A period at the end of today's webinar. We love getting questions from the folks, so please feel free to ask questions at any time. If you'll take just 2 seconds to glance at your GoToWebinar control panel, you'll see a little section there called questions. Type it in, it'll go into a queue. We'll do our best to get to it during the Q&A period. Finally, after today's webinar closes down, you will be asked to take a short survey. It's about 60 seconds of your time. We love to get your feedback. We always want to know what we can be doing better. The speakers love the feedback, so they know what they can be doing better the next time. And also, if you would like to be connected directly with today's speaker, you can make that request with the click of a mouse during that survey. We simply ask, you click yes, and boom, we'll happily make that connection via email. If you have follow-up questions. We have a number of learning objectives today, but we definitely want to help everyone on the call today really understand how your IR activities impact your company's valuation and what the primary measurements are and the levers that you can pull to build an effective investor relations program. Joining us today to help us learn all about this, I'm very happy to introduce Phyllis Profer, who is owner at The Heights Company, LLC. Phyllis has 35 years of business experience, primarily as a corporate investor relations executive. She has a track record for increasing the PE multiple of companies that she has served as the investor relations officer. In addition, she has experience with companies immersed in challenges such as aggressive growth by acquisition, downsizing by significant divestiture, separation from parent by spinoff, turnaround situations, industry downturns, and earnings surprises. All of that good stuff that can hit you from time to time. Phyllis has a bachelor's degree from Southern Illinois University, a master's degree in communication from St. Louis University, and an MBA from the Fuqua School of Business at Duke University. She is a member of the National Investor Relations Institute, also known as NIRI, and serves on the board of directors for the San Francisco chapter of NIRI. And with that wonderful background and introduction, I would be happy to hand today's presentation over to Phyllis Profer.
Thanks, John, and thanks to all of you for joining the call today. I think regardless of the size of the IR organization or whether you're using external resources or not, using analytics to provide your IR communications works for any size public company, pre-IPO, or even an established public company. So my prepared remarks today are organized into 4 categories shown here. Collectively, they represent the very basic framework for creating and tracking the progress of an IR plan. This is a process I've used throughout my career. All 4 are interrelated. Really addressing or concentrating on 1 or 2 without building a program around all 4 will not deliver the same results. So maintaining access to capital markets, that's sort of the who. Increasing investor knowledge, that's what you're going to communicate. Creating the communications, that's how you plan to communicate. And of course, increasing liquidity and minimizing volatility, That's why you do all of this. You want a fair valuation for your company's common stock, and you'd like to achieve an orderly market. So having said that, what is involved in achieving remarkable results? Typically, it's human nature. We achieve what we measure. So IR is no different than any other department within the corporation. It is a function that involves the highest level of the company in a very public way. Therefore, it deserves a well-thought-out strategy with measurable objectives and the ability to monitor the progress toward that fair valuation and orderly market. Also, by using analytics, you have the ability to assess and adapt your activities as you go along. There will be unexpected events. There'll be a change in corporate strategy at any given time, expansion, consolidation in your markets, new competitive threats, number of reasons that may take you and cause somewhat of a distraction. So having a plan in place is a good thing. And as we look at some common hurdles why companies don't do more planning than they could do, is they may be establishing objectives that are unrealistic or difficult to measure. Reacting to the demands of an increasingly short-term focused investment community is a very common hurdle. There's been a growth in high-frequency trades, program trades. There's a speed in information about what we do today, and they can cause some very real, important distractions. A plan's going to bring you back to where you need to be and focused on the things you need to be focused on. There's also a tendency to spend a disproportionate amount of time with the sell side. And forgive me here, I have throughout this presentation used the term sell side and buy side. For those of you who are new to IR, sell side are brokerage research analysts. The buy side are institutional investors who actually buy and sell shares and hold shares of your company's stock. But spending a disproportionate amount of time with the sell side, these are very demanding folks. They publish research coverage on your company. You want to make sure that you're allocating time to speak directly with your shareholders, whether they're existing or prospective shareholders. You don't want to use a sell-side analyst as your gatekeeper. Investing time with the wrong investor. We're going to spend quite a bit of time talking about shareholder mix, different investment styles, and the importance of having investment styles match your investment characteristics. Sending mixed messages, we'll be talking about that. And offering you some analytics that you can use to evaluate the progress that you're making on your IR activities and indicating any changes that may need to occur. So you're not going to need just to rely on your stock price alone, and we'll explain later about why that could be an issue. Right now, John has a polling question before we proceed.
Thank you. So this is the first of the 3 CPE polling questions that I mentioned earlier. So I'm going to go ahead and launch it. That should show up on your screen in about 2 seconds. There we go. Please select one of the items below that best describes investor relations planning at your company. Once again, we'd like to hear from everyone, whether you're here for CPE credit or not. Certainly for the folks who are here for CPE credit, you need to answer this. But quick, simple question and statistical in nature. And actually, we will turn these results around if we have enough time during the Q&A portion of today's event so that everyone can see where everyone else stands. And I'm going to go ahead and leave this out for another 5 seconds, so if you haven't gotten your vote in, please do so quickly, and then we'll close it down and get back to Phyllis. So I'm going to go ahead and close it down right now. And Phyllis, I'll forward your next slide, and back to you.
Okay, great. Thank you so much. So let's move on to applying analytics to maintaining access to capital markets, essentially the who. We all spend so much time on compliance and disclosure, we frequently need to remind ourselves about whom we are delivering these well-crafted strategic messages. The investment styles of institutional holders should match the investment characteristics of the company. There are tens of thousands of portfolio managers with different investment styles. You don't need to be all things to all people. Your company's investment characteristics will be attractive to particular investment styles. You do, however, it is your responsibility to get on the radar screen of appropriate institutional investors. It's also your responsibility to help them understand why your investment characteristics match their investment styles. Shareholder mix is a great measure of message clarity and time allocation. So an analysis of your shareholder mix also leads to an efficient tool for targeting institutional investors for future changes in your investment characteristics. As your company continues to grow and evolve, your investment characteristics will change, and so will your shareholder mix. And the important part about that is that the investment styles of your shareholders definitely influences their perceptions, which can make it difficult to manage expectations if those investment styles do not match your investment characteristics. So what I'm saying essentially is growth stocks should have growth investors, value stocks should have value investors. And it's never that clean and neat. There's always a mix. And the next couple of slides, I'll show you how that can happen and how you can change that. So growth investors, and there are different segments of growth investors, from core growth to aggressive growth to growth at reasonable price. But they're seeking stocks with earnings expected to grow faster than the industry and overall market. Value investors are seeking stocks that they believe the market has undervalued despite the company's long-term fundamentals. There are also different segments of value investors, from deep value, looking for significant change in a company, to core value. The bottom two on this chart, hedge funds aggressively manage portfolios using advanced investment strategies. Because, and hedge funds can be short or long, so you can't make blanket statement about hedge funds, but the shorts are generally very high turnover characteristics. So they have to stay very close to the story. So it's a little bit deceiving. The people you will hear from most are the people that are probably trading your stock more frequently. There are also the folks that become very good clients of brokerage houses. So as you consider marketing your company with the help of a sell-side analyst, just keep in mind their biggest clients are probably hedge funds. So when you go to conferences or you market one-on-one meetings with a brokerage house, you will be talking to a high proportion of hedge funds. So if you spend most of your time with hedge funds, a lot of your stock is going to be held by hedge funds, and they're going to represent a very large proportion of your investor mix. The way you correct that is targeting growth or value investors depending on your investment characteristics. You need to be strategic and very fair about how your time is allocated. And let's take a look at a couple of examples. This is pulled this from an analysis I used to prepare an investor relations plan for a company which had lost nearly 50% of its value. After 2 years of absence while working on a turnaround, they wanted to increase management's accessibility with the financial community, and that's why it was hired. It was a mid-cap company, about a 2.6 billion market cap, about 130 million shares outstanding, average trading volume of about 4.5 million shares, and there were 18 brokerage houses publishing coverage on the company, so it was well known. Unfortunately, their absence and decline to meet with people with the financial community had caused some confusion in terms of their investment characteristics. And that was going to be a real challenge to manage those expectations going forward. As you can see here, there was almost an even split between growth and value investors. It was a turnaround situation. It would make more sense to have value investors than growth. Another difficulty in changing the ownership mix of this particular company was a high proportion of shares held by index. Index funds, as we pointed out on the other slide, are really not influenced by company fundamentals. So they had removed a part of their float and had very low turnover characteristics. It was going to be difficult to change this mix. They're still in progress on this, so the jury's out. But I do have another example of a company I can talk about. It's no longer in process, so I have some very good data to share about changing the mix. I pulled the following slides from a board presentation I did several years ago. This data represents the shareholder mix used to create the IR plan. The company had less than 40 million shares outstanding, and an average daily trading volume was around 200,000 shares prior to my joining the company. There were only about 3 brokerage houses publishing research on this particular company. It was not well known. It was a turnaround situation, and they had an entirely new management team, so they weren't very well known either. Our challenge in the shareholder mix for a turnaround situation had a very high percentage of growth investors in its mix. This was primarily due to our largest holder. It was a growth investment style of growth. And the problem being he was holding the shares, or this particular institution, the portfolio manager, was holding these shares because he viewed the company as a potential acquisition candidate. In fact, he was quoted in the media talking about what a great acquisition candidate the company would be. We had a new management team that was entirely focused on turning around the financial results for this company and the operations. And we were not for sale, nor did we intend to sell the company. We wanted investors to value the progress we were making on the turnaround situation. So what we did is take a look at who should the investors be. Obviously, it was value investors, growth investors later on. So the deep value investors were important in the beginning of the turnaround, but we needed core value investors waiting in the wings as the company improved its financial results. If the turnaround was successful, we knew we could grow earnings at a faster rate than sales, which would be less attractive to growth at reasonable price investors and more attractive to core growth investors. We achieved our shareholder mix objectives by concentrating on our messaging and targeting institutional investors. Obviously, the transition you see here would not have happened if our financial performance had not improved. But it's a great example how you can change your shareholder mix. It takes more than days and weeks. It does take years to achieve this. And it is all about your message clarity and targeting the right investor. What happened then, there was a change in the turnover characteristics. As you can see, the year 1 of when we implemented the plan, year 2, year 3, year 4. By year 3, we had moderate turnover characteristics. So we had the ability to increase the liquidity of the shares of stock. And although stock price was never one of our measurable objectives, we did improve the stock price over time. Our functional metrics included the number of conferences, the number of research coverage, one-on-one, small group meetings, trading volume. We used our shareholder mix to determine how well we were communicating our investment characteristics, present and future. The one dip that you see toward the left-hand side of this was actually it happened to the industry. It was an unfounded concern about the industry that was just unjustified. But it happened to us. It happened to everybody. Other than that, we had a fairly orderly market in terms of creating new highs and new lows for the stock. So let's move on to increasing investor knowledge and understanding about a company. As I mentioned earlier, articulating your investment characteristics and staying true to them is important to attracting investment styles that accurately match your investment characteristics. Companies are expected to grow earnings, but that doesn't necessarily make them a growth company. How a company grows its earnings is represented in its investment characteristics. And I've shown on this next slide how you can approach that. You want to decide early what to share with investors and be prepared to provide updates to them on a regular basis. So you have a couple of considerations in that as you're thinking about this. Whatever is public, your customers also see that. Your competition also sees it. Once you offer information, and you can do that when it's good, you're going to need to provide an update on that information and those proof points, even if it's bad. So some considerations here. Keep in mind your customers see this information and your competition sees it. But you do need to satisfy the need for investors to analyze various equities. So that's the quantitative information or the finance part of the financial community. So you articulate your investment characteristics and long-term strategy, help investors put things into perspective, provide proof points and update regularly, contrast and compare with your peer group. And this last item, you need to be objective but not complacent about your brokerage research coverage. They own the opinions. You really can't weigh in on that. But if you see inaccuracies in the research reports that are detracting from your investment messages, you really need to address that. I've provided here a list. They look pretty simple. I didn't put a lot of words around them because each company will have to do that for themselves. You need to, in articulating your investment characteristics, you want to take a look at your ability to compete. So why do customers come to you rather than the competition? Is it your market coverage, better distribution? Do you have a better known brand name, higher quality products, services? Are you bundling those services? Are you low-cost leader? But what is your ability to compete? Sales growth trends, what are the drivers? Is it market growth, share growth, and is that based on unit growth, market expansion, product and or technology innovation? Are you going to grow with your markets, or are you going to grow faster than your markets? As example, productivity. How do you convert sales into earnings? This is probably the most important element in the investment message. It determines which institutional investors you want to target as prospective shareholders. Companies that can grow earnings at a faster pace than sales usually get a premium. Earnings growth. Is it sustainable long term? This is somewhat of a double-edged sword. You want to manage expectations, but you also don't want to put false promises out there that you have to revise later on. Balance sheet and cash flow. How much does growth cost, and how will you fund that growth? It took me less than a second to make that statement, and there's a lot of work that has to go behind a capital formation strategy. But that's something you want to share with investors. Controls. Do you have the necessary controls in place to achieve each one of these items listed on this slide? Real-life examples. I worked for an aggressive growth company. We made about 6 acquisitions in a 2-year time frame. And we were able to pay and fund that type of growth. But we grew so quickly, and the integrations didn't go as well as they needed to go, that expenses just grew out of control, and the company ended up hitting the wall. That's not a good feeling. Then I worked for another company. They were installing a new supply chain system, and a big chunk of inventory went missing. We had to take a write-down, which negatively impacted earnings. Surprisingly enough, because we had talked about this in advance, that we were putting in a new supply chain system, the reaction by investors are pretty much, well, this wasn't as bad as what we've seen at other companies. So transparency is a good thing, and time is on your side as you release information to companies. Now, John has another polling question for you.
You betcha. Thank you, Phyllis. So this is polling question number 2, launching in about 2 seconds. And there we go. The percent of employees who could accurately describe 3 or more investment characteristics of our company is. So we'll go ahead and give you about 30 seconds to weigh in on that. I'll take this moment to remind folks to ask questions at any time via the question area of your GoToWebinar control panel, and we'll do our best to get to those questions when we get to the end of today's presentation. I'm going to go ahead and leave this question out for another 5 seconds or so, and then we will get back to the presentation. So I'm going to go ahead and shut this down now, close, and Phyllis, back to you.
Okay, great. Thank you. Getting back to managing expectations. Management's ability to predict future financial results begin with accurate financial reporting. I realize I'm speaking to a whole group of financial folks, and you absolutely understand the importance of having the structure necessary to make sound, accurate financial projections, as well as having a system in place to provide that link between current operating performance and future financial results. You have the opportunity to really, before you go public with any of these items, to really test that within your own organization, monitor that, and then go public with it. Companies need to establish a consistent practice of corporate communication and product announcements. Communication is cumulative. Websites, product announcements, news releases, or any customer-oriented material generated by your marketing department will be used to gain a better understanding about your company by investors. So the question is always going to be, how does that impact finance? So if you really take a hard look at the flow of information that exists in your organization, an approval process, clarifying roles and responsibilities will help you avoid a situation where a marketing announcement may get out there before you're ready to really talk about the financial implications. Always, you need to establish mechanisms to monitor perceptions by both your shareholders, existing, prospective institutional holders, and also on the sell side. Those can be very formal, such as looking at your shareholder mix or doing a perception study, to being quite informal through logs, Q&As. We'll talk about that in a few minutes. I would be remiss if I didn't put some information out there about survey on guidance. I have my own opinions, but the NIRI organization does a survey every couple of years. This is their most recent one. 88% of the companies surveyed do provide some form of guidance. 76% provide financial guidance. I've given the top 6 in the order of magnitude. And also at the top of this, I gave you an indication there. The respondents included large cap, small cap, and mid cap companies, probably more weighted toward mid cap than anything else. But it is quite common practice for companies to provide some form of guidance. I'd prefer to look at it as management outlook. But the first and foremost, if you don't have a system in place to do that accurately, it's not worth risking your credibility to be wrong. Moving on to applying analytics to create communications to promote sound investment decisions. This is a good section to emphasize how the stock price isn't the only measure a company should use to measure the effectiveness of its messaging. When you look at investors and how they collect information about a company, they really need to hear the message more than once. I've listed here a number of items that your company can use to emphasize its investment characteristics and provide proof points. When you're looking at analyzing the effectiveness of communication, there's some feedback loops you can use very informally. As you talk to investors, whether it's IR, the CFO, CEO, keep a log of those telephone calls. And I'm not talking about an extensive one-page summary of everything that you talked about, but you're looking for discernible patterns of questions that may come up frequently or items of confusion that you can incorporate into your communications to investors rather than waiting for it to be a Q&A. Also, one-on-one meetings and small group meetings, it's a great way to collect information about your company from the institutional investors who you're trying to reach. And then, of course, you have the shareholder mix, which we've talked about previously, trading activity, which we'll talk about in the next section, to use as ways to assess how you're doing in IR, assess how companies or how institutions are understanding the message or not. I would like to draw two things out of the message continuity and timely disclosure. These two items here provide the greatest opportunity to get off message. I talked about mixed messaging previously. It's so easy to get off point during a small group or one-on-one discussion with investors. It's really best to use a discussion document, which is nothing more than a slide deck, to guide the conversation with those institutional investors. It's also just human to want to answer questions as accurately and comprehensively as you possibly can. There may be questions that are asked that really have nothing to do with your company. It could be a channel check, but it's taking them off point of your investment characteristics. So you'll want to take control of those meetings, just as you would if you were being interviewed by a media person. The interview obviously has questions, but as much as you can take control of that conversation, the closer you will get to more accurate expectations for your company. So building credibility, it's worth spending a second or two on this. You develop your strategic messages, you create these realistic expectations in a reasonable time frame, stay true to your investment characteristics. We've talked about all of this, maintain your consistency and timeliness. You'll want to avoid being overly promotional. And what I mean by that, we all feel very positively about what we do. We feel very positive about our future. Just keep in mind you're managing expectations, whether you're providing quantitative information or qualitative information. And the other piece of the equation is you want to be able to contrast and compare with other in your industries, while being conscious of not providing competitive information. I have shown here the START, and it's something I used initially with a company to begin the conversation of who should be in their peer group and what elements should we compare with the peers. You'll see the top group of 4 companies. Those are pure play comparisons. The next 3, they sell more than what the company in question was selling. So they were in the same industry, but it was a small part of their larger business. And then the bottom group are people that are in the same industry, companies in the same industry, but not necessarily serving the same segments. It's a great starting point for looking at your peer comparisons. And the reason that's important, you're going to want to be very familiar with what your peers are providing in their SEC filings, looking for differences in accounting treatment. So if you get that question from an investor, why is your capital expenditures this compared to another company, you would be able to answer that question intelligently. You want to contrast and compare the operating and financial metrics that are important to your specific industry. You're going to want to follow the brokerage research coverage and content for your peer group and people that are in your industry, and compare the key dates such as earnings releases, analyst days, etc. And another really key feature is the trading activity for your peer group, industry, and overall market. Your stock will trade with your financial results, but it will also trade with your peer group, your industry, and your overall market. John has another polling question. John?
Thank you. Yeah. So we're going to launch the third polling question now, and it's coming on in a moment. And the corporate department responsible for performing my company's peer group analysis is, and as usual, we'll leave this open for 30 seconds. Let folks answer this. Once again, whether you're here for CPE credit or not, we'd love to see what the answer is. So we can have a good cross-section of folks. I will take a moment right now to remind everyone that at the end of today's 1-hour webinar, we will be presenting you with a brief survey. It takes literally 60 seconds to complete. We greatly appreciate your giving us that time so that we can always do better the next time, which we love to do. Also, at that time, we make it really easy for you to connect directly with Phyllis, or for us to help you connect directly with Phyllis. Just check the box next to her name, and we will happily make that connection. And that is it for this polling question. We'll go right on and head back for Phyllis to go through the rest of her slides. Here you go, Phyllis.
Thank you, John. So when you're looking at increasing liquidity and minimizing volatility, there are plenty of analytics and data to analyze this last section. The key here is the interpretation of the data. So an analysis of your historical trading activity will help determine whether volatility is a significant problem and if it's correctable. It's also going to help determine an appropriate daily trading volume range for you to set as an objective for your company. And I've already talked about you want to really assess how your stock trades relative to your peer group and industry. I have a few examples to share with you on that. This here, the company that I talked about, the turnaround situation that was so successful, we never chose a stock price as something that we wanted to measure, but our original goal was to increase the liquidity. And then after year 2, year 3, we really said, okay, if we stay within this particular average daily trading range, this is an orderly market. Anything outside of that trading range, we really need to investigate what happened and what caused that to happen. Did we need a course correction in our IR activities? And as you can see here, volatility is relative. I have 4 company stock trading charts shown here. They're all 4 in different industries. 2 are NASDAQ, 2 are New York Stock Exchange. So volatility is relative. You can't tell a lot just by looking at these stock charts. But I do have an example I would like to run through with you because I do think it's something worth looking at for your company or any future company you may be with. This is a company that's a $1.7 billion market cap, quickly becoming a consolidator in its industry. So if you look to the left-hand side, that first dip in May 2010 was a downside earnings surprise. And then as the stock recovered in July 2010, they had a merger announcement. It was a sizable merger. They've had several acquisitions that they've done that appear on the stock chart, but nothing made it move such as this one did. Then you get to 2011. There was a significant change in its go-to-market strategy, not well received by the financial community. You get to practically the middle of the stock chart, May 2011, they announced strong earnings and clarified that the merger announcement that they had made nearly a year prior would be integrated for the most part by the middle of 2012, which is practically a year later. So they're talking a 2-year time frame here. Beginning in 2012, you see a little more uptick in the stock price. They talked about the completion of a strategic plan along with management outlook for sales and earnings for 2012. Unfortunately, before 2012 was over, they would raise their sales estimates but lower their earnings, and you can see what kind of reaction that had in the stock price. I'm not close enough to this company to know if some of the stock gyrations could have been avoided, but it's a good example of what you can do in terms of looking at the volatility of your stock price and seeing if there's something along the way that you could have done that may have caused it. Taking a longer historical view. Now, the company in question is that blue line. So if you take a 5-year view rather than a 3-year view of this company, you can see in the furthest left-hand side how they pretty much traded with their peer group. I only selected 3 or 4 peers here, so we wouldn't have eye candy. But if you notice particularly here, they actually traded at a premium to their peer group. And then you can see after all of this work on acquisitions and integration and everything else, they're back to pretty much trading with their peer group. So one of the things you want to look at when there's a change in your investment characteristics, you want to be able to use the time, as you know, as you're approaching some of these, whether it's an acquisition, a divestiture, or a spinoff, you have time well enough in advance to be able to formulate a message here. What is the strategic significance of this change in investment characteristic? If it's an acquisition, you could look well in advance of announcing an acquisition to start talking about some of the criteria you would use. Obviously, you don't want to play your hand to your competition. You don't want them to purchase a company you had planned to acquire. At the time of announcement, give a timeline for the integration. Provide information about the synergies as much as you possibly can. And also let people know if it's accretive or dilutive at the time of announcement. So the more prepared you are to offer comprehensive information in a timely fashion that you make the announcement, you will achieve a more orderly market for that announcement. Divestitures or spinoffs, I've been with a company, I was with a company that sold half of its business. I've been with a couple of companies that have spun off divisions. Prior, we know well in advance that's going to happen, and prior to that, when you offer segment data pre-announcement, so a year or two in advance, try to tee that up so you have something to fall back on when you make the announcement. Then, of course, when you make the announcement of a divestiture or spinoff, you want to be able to talk about the timeline for achieving everything you need to achieve. These next slides are merely a recap of what we've talked about. So here are the 4 areas where you can apply analytics to really make a difference to your IR activities. Here's a recap of the measurable objectives. I've talked about those as we've talked about each one of the areas, but here's a recap of it. Now, one thing we didn't talk about, it's kind of involved in the conversation in the script, if you will, not so much on the slides. Here's some examples of actionable tactics. I offered this as merely an example to help you create your own IR plan or apply analytics to what you're doing. Monitoring performance. Gosh, this is so important. If you're going to go through the process of setting up a strategy and really trying to identify some measurable objectives of your IR plan, it's certainly worth using those items to monitor your performance, how you're doing. It's a great way to do a course correction if necessary in your IR activities. It's also a great way to keep your board up to date on what's happening in your IR efforts. You need to manage their expectations just as you manage the expectations of the investment community. That's the end of my prepared remarks. Thank you very much. I'll hand it back to John for Q&A.
Great. Thank you so much, Phyllis. Really appreciate that. Fantastic insight and things that you simply don't find that frequently, that kind of insight into what's going on in the world of IR. So greatly appreciate that. At this point, we're going to go ahead and get into the Q&A section. And we're going to go ahead and start that off by looking at the polls that we took earlier, and take a look at some of the results and asking for Phyllis to comment. The first one was, please select one of the items below that best describes IR planning at your company. The biggest there is that private, privately held folks, so no IR. But it's interesting, the second most was our formal strategic planning process does not include IR. Is that fairly common? I actually find that not too surprising, but what do you see out there, Phyllis?
I think there are variances between small cap, mid cap, and large cap companies. I think it may be a product of time. I think the more that people understand that actually creating a plan is very efficient and productive, they'll make time for it. But I think usually large cap companies will have a plan where the small cap and even some of the mid cap may not. Mm-hmm. They should, but they don't.
Right. Okay, next polling question was the percent of employees who can accurately describe 3 or more investment characteristics of your company is, and you can see the layout there. And, less than 10% down to 1% is 50%. Of the companies here. So is that that's also probably not terribly surprising. I mean, most companies are sort of IR activities held to the CEO, the CFO, and the IR leader?
I would say that knowing the investment characteristics shouldn't be limited to just the C-suite and the IR folks. Sometimes employees are the company's largest group of investors through the profit-sharing plan. And if options are offered to those employees, excuse me, you would want those to be higher. Having said that, I am not surprised by these results.
And we'll take a quick look at the third and then get into questions for today. So the third polling question was the corporate department responsible for performing my company's peer group analysis is, and this can't be too surprising, accounting, finance, and treasury is the largest. Phyllis, at what point do most companies, size-wise, break out a standalone IR capability?
Wow, that's tough to answer.
I want to keep you on your toes this morning.
Well, yeah, no, that is a little tough to answer. I have worked for small cap, mid cap, and large cap companies. And I would say large cap, definitely. Mid cap, definitely. Smaller cap companies, actually, good answer to that is, if it's a relatively new public company, a recent IPO, investors want to talk directly to the CFO and CEO. So the IR function exists, but they may not have an IR person on board. So if you're asking me when do people add IR people, I would say usually an established company, and it's approaching a $1 billion market cap. That's a guess.
And how much investment would let's say, a typical mid-cap company make in an IR capability? Is that just one human being, a Phyllis Proffer for the company, or is there staff there, and how much investment is appropriate?
Because IR is a team sport, the IR department is typically part of the finance department. So if there are folks like here, if you have somebody in accounting, finance, and treasury, that can do the peer group comparisons and stay on top of that. It does. Let me answer it this way. IR should be integrated with the company. It shouldn't be overlaid on top of a company. So there's lots of flexibility here, and achieving the function may require a person, may require an external resource like an agency or consultant, or it could be achieved by the corporate communications and a combination of corporate communications and the accounting finance area. It's flexible.
Okay. Great. So let's go ahead and jump into other questions that we've got. Number one, how do you access the most current information regarding your shareholder composition? What's the most practical tool for doing that?
There are databases available that you purchase. They're online, and it provides for you information about existing shareholders, who's holding your shares, what their investment characteristics, turnover characteristics, contact information that can be used for targeting, as well as monitoring your shareholders. I will tell you that the most definitive on who's holding your shares come from 13D and 13F filings with the SEC, which are done quarterly. And the institutions have 45 days to report their ownership. And so that can be a very slow process. You can also hire companies to do what's called stock surveillance. There are a couple of very good companies out there. It's something you want to test from time to time using information they provide you. You can always test it against SEC filings to see how accurate they are. But yeah, so it's easily available, not expensive. For the database, a little more expensive to have stock surveillance.
Mm-hmm. So how does a company protect against unforeseen attacks on their stock, such as activist shareholders?
Yeah, that's great. That's a great question. There is a growth in activist shareholders. There's a growth in more verbal dissident shareholders. The plan is going to help you regardless of what happens. The only thing you can do when there's an activist, and there's different forms of activists now. It's almost seen as a, somebody used this, this is not my term, but I went and attended a meeting about activist shareholders, and it's almost an investment style now. So not all activist shareholders are going to take over the company, boot management, tell them what to do. There are activist shareholders that get into your stock that won't go that far. There's only a handful of companies really that would do that. But you want to be as close to that shareholder as you possibly can, so you know what it is that they're thinking, just like any other shareholder that you have. And the way you can really guard against the kind of shareholder that's going to cause disruptions to your business is to manage that business as well as you can and achieve the financial results. Have credibility with your investors. So we go back to a couple of the slides that talked about managing expectations. If you have the right shareholder mix that match your investment characteristics and you've well articulated those investment characteristics, it's going to help you manage expectations, which only improves your credibility with investors. So someone could get into your stock under the heading of activist shareholder, and the amount of trouble that they're going to be able to cause you or your company is going to be somewhat diluted. So in those instances, it just makes a very good argument for using analytics to create a strategy and an IR plan and to monitor that progress on a regular basis. You can't prevent them from buying your shares, but you certainly can dilute some of the impact of their holding your shares and, quite frankly, some of their interest. They'll sell the stock if they can't achieve what it is that they wanted to achieve. They'll move on to the next guy.
Are there any situations in which it's desirous to have shareholders that are index-focused versus investors looking at growth or fundamentals?
Yeah, no. Well, certainly it removes your float. It removes some of your float by having index. It's not something you go out and recruit or prospect index. They don't meet with you anyway. So yeah, if you're, yeah, I mean, it could be helpful to have index investors if your float is difficult to manage. It could be. It depends.
Depends on your strategy.
Yeah.
Right. Okay. Great. Well, you know, at this point, we've got a little bit of housekeeping to do before we shut it down. First off, a couple quick items. You will be prompted to take a short survey. We talked about that. We're a minute away from that, so appreciate everyone giving us their quick feedback there. Of course, please join us at Proformative.com. If you have any additional questions, and I know that Phyllis is a Proformative user, and we've got a lot of smart folks out there, and we'd be happy to have your questions asked and answered there. If you have any questions about CPE credit, please contact Chris Brower. You can see her email address right at the bottom of the screen. She's extremely friendly and helpful. If you have any questions, she'll take care of you immediately. One quick note, we do have the Proformatech conference coming up in March 20th at the Hyatt SFO. And speaking of analytics, there will be all manner of technology present, fintech, everything from finance, treasury, accounting, et cetera. It's going to be a great event with great speakers, and we hope to see folks there. And finally, of course, thanks to Phyllis Proffer. Phyllis, just great information this morning. Really appreciate your giving us your time and insights. And we appreciate your being involved with Proformative, and I hope you continue to do so. So thanks for being with us this morning.
Thanks.
And with that, I'm going to go ahead and close down the webinar. Everyone will be presented with that short survey. We greatly appreciate it. Once again, if you want to connect with Phyllis, it's a click of a mouse away during that survey. We hope everyone has a great rest of the week, and we hope to see you again at Proformative.com or at another Proformative event. Take care, all.